everyone. Welcome to our latest Lunch and Learn with CIBS. And today's topic is 1031 exchange concepts for commercial brokers. And please welcome our guests today. First is Pamela A. Michaels. Is an attorney, has been a senior vice president of asset preservation for over 15 years. Pamela specializes in guiding attorneys, CPAs, investors, financial advisors, and other real estate professionals through the regulations and requirements of 1031 exchanges. Pamela has a strong background in operational, financial, and legal aspects of real estate, including real estate acquisitions, financing, construction, and sales. Asset Preservation, a subsidiary of Stewart Title, is a leading national IRC 1031 qualified intermediary and is efficiently handling exchanges in every state. She is a member of the Ohio Bar Association since 1985 and the Florida Bar Association since 1986, as well as an instructor at the Real Estate Board of New York, CCIM, ICSC, SIOR, and CIBS. Pamela is also an author of numerous articles, publications, including the New York Real Property Law Journal, the New York Real Estate Weekly, the New York Real Estate Journal, the New York State Society of CPAs, and the Mid-Atlantic Real Estate Journal. Pamela earned her bachelor's degree at Kent State and her law degree from Ohio State University. So welcome, Pamela.
Thank you, Leo.
Also with us today is Roy Flager II, who has been in financial services for over 10 years. He began his career at one of the country's top John Hancock agencies. Roy quickly excelled to become the director of operations, where he managed 12 staff members across 2 different offices located in Westbury, Manhattan, that housed 55 representatives. Roy joined the independent broker-dealer channel in 2014 to further his career as a financial advisor, where he developed a focus for alternative investments. Roy has been working with real estate investors as an independent financial advisor for the last 7 years, assisting them with alternative investments and 1031 exchanges. Roy has helped execute over $500 million in 1031 exchanges involving the Delaware Statutory Trust. Roy is a frequent presenter for many associations. He has presented for the New York State Society of CPAs, the Suffolk County Bar Association, the New York School of Real Estate, the Long Island Real Estate Investment Association, and many more. So please welcome Roy.
Thank you very much, Leo.
So take it away, guys.
Thank you very much. Thank you to CIBS for having us here today. And Roy and I are going to share this presentation, and I'm going to start off by distinguishing our roles. So I am a nationwide qualified intermediary. When an investor wants to perform an exchange, they need to engage a QI, qualified intermediary, to facilitate the exchange. So today's presentation is really going to focus on what commercial brokers need to know about the process. And that is something important that commercial brokers need to know, that you need to engage a qualified intermediary prior to the sale of the relinquished property to perform an exchange. Now, most of my clients reach out to me way before they're even thinking of signing a contract, because planning is the most important part of a perfect 1031 exchange. So you can never plan too early. Many times it's the commercial broker that will reach out to me because they have a client that may be selling XYZ, that owns it in an S Corp or a partnership or individually. And they want to know, do we qualify? How do we need to structure this? The broker wants to get the client off on the right foot. So I get involved early many times, and sometimes late. But if it's after closing, it's too late. And Roy is going to fill a different part of the exchange process need. Roy is going to provide replacement property solutions. So anyone that's ever been in a 1031 exchange realizes that basically If you don't have replacement property lined up in time, all of the work you did on the exchange is for naught. And in time, as we're going to hear, is basically you've got to list those properties and send us a list of what you want to buy within 45 days after closing, calendar days, and you got to close on everything you want to buy within 180 calendar days. So Roy is spectacular at helping clients with replacement property solutions customized to meet all of their exchange needs. And Roy and I work together often and for many years now. So I am quite sure that Roy understands all of the 1031 requirements, which is so critical when you're looking for replacement property. I have clients that have realized on day 50 that what they identified won't work because they identified something that we couldn't tell, but they were planning on buying a partnership interest or a membership interest in a JV. Well, that won't qualify. So between Roy and I, we hope to keep you out of the trouble, but that's the kind of issue that can come up too late in the day to save the deal. Okay, so we're going to start off with a little bit of a summary. As anybody saw the news this morning or whatever, we're getting an increase to our capital gain and ordinary income rates soon for high income earners, and likely to increase tax rates to the pre-Tax Cut and Jobs Act level, increase corporate tax from 21 to 28%, and 1031 exchanges. I have a question mark. And the reason I have a question mark is that pre-election in Biden's proposal, he included something to eliminate or limit 1031 exchanges to those income earners of no more than 400,000. Now that seems to have gone by the wayside. We do not see in the current legislation that's going through Congress any comment about modifying 1031 exchanges, but you know, the story is not over. So everybody needs to stay tuned on that issue. We are expecting tomorrow some announcements on where corporate capital and corporate tax rates, capital gain rates are going, and ordinary income rates are going. And of course, it still doesn't mean it's law, but it's going to give us some idea of what direction everything is headed. Very notably, I know some of my clients don't realize this, but with all of this discussion about tax rates increasing, and you're doing deciding right now if you're going to do a 1031 or not on a sale that's going to occur in 2021, if you liquidate, you could be subject to higher income tax rates because basically, in capital gain rates, I should say, because they very well could make any increases retroactive to January 1 of this year. That is not, would not be a surprise. And I think that's the way it goes more times than not. So everybody should prepare if they are not doing a 1031 to get involved with some higher rates and be paying more tax. And of course, New York rates are going up too. I think New Jersey haven't gone up this year, but New York is definitely going up. A couple other things that have happened recently in our 1031 world. So last year with COVID, we got extensions to our 45 and 180 day deadlines. Those extensions are finished. They ended last July, and there are no further extensions in place. So if you're about to do a 1031, you need to abide by those timelines, the 45 and the 180 days. Something else very interesting that happened that I think is relevant to commercial brokers is last fall we got new regulations issued by the Treasury on what is real property for the purpose of 1031. And it expanded what could be considered real property. So if you fit within one of three different areas, you will qualify. So we used to think it had to be real property under state law. Well, that's one way you can qualify. If it is real property under state law, it's 1031 qualified. But they expanded that list to also include, even if it's not state law real property, if it's a listed asset under the regs, it can be real property. And that list is expansive. They included cell towers on the list, for instance. And even if you're not a state law real property or listed assets real property, you can still qualify as owning real property if you own real property based on all the factors and facts and circumstances under what they call the factors test. So I know most of us just sell buildings and that's real property and there's never an issue. But there are some kind of interests such as air rights, water rights, mineral rights, where there is a question, am I selling real property, leaseholds, easements, things of that nature? So we have some very taxpayer-friendly legislation now, and it should be helpful in finding a way to qualify many sales as real property transactions, even if before we thought they might not. For instance, one comment under the list of listed assets is option contracts, which historically we all considered to be personal property, and still might be unless it's qualifying real property, which I'm about to get to in a moment. So we need real property and it needs to be qualifying real property. Before I get to what's qualifying real property, let's just talk a little bit more about our current rates. Our current capital gain rates are already at an all-time high. It's about 23.8% on the federal level without even considering the tax on your depreciation recapture, which is at 25%. So if you have a sale and you have $3 million of gain and you had $1 million of depreciation, the $1 million will be taxed at 25%. The $2 million balance of the gain will be taxed at 23.8%, presuming you are a high income earner and subject to the net investment income tax. And of course, the applicable state and local rate if you or the property is in the city or the boroughs. So easily, every taxpayer is in what? 33%, 35% for the average individual. We don't have to even get to be discussing corporate tax rates and things of that nature. Now, last year, and this is going to change this year, but we still haven't heard how because they're muddling around with the capital gain rates. But the 20% rate last year, and to this point, to our knowledge, applies to single filers with income over $441,550 and married filing jointly $496,600. If you are subject to the 20% rate, you're also going to be above the threshold required, or which pushes you into the net investment income tax bracket of 3.8% because that threshold is lower. That doesn't mean that every taxpayer is subject to the net investment income tax rate. You have to check with your CPA, but if you are, the threshold is lower to get hit with that tax. It comes into play at $200 and $250. So those are our summary of our rates. I've gone pretty quickly over that because I think this is going to be fairly meaningless fairly soon. I think we're getting a whole new, our taxes are going to have a whole new identity shortly, so to speak. So as I mentioned, we have to have real property. That's good. But one other very important determination when we're determining can we do a 1031 and do we qualify is do we have qualifying real property? And qualifying real property is real property held for productive use in a trade or business or for investment. And those terms mean very special things to the IRS. So not everybody that's selling a piece of real property is going to automatically qualify for 1031 purposes. You have to have held it for productive use in a trade or business or for investment. So investment to the IRS means something different than it means to you and I. And to qualify as held for investment for IRS purposes, the IRS will look at about 8 different factors. And one of those factors is the holding period, but not the owning period, the owning factor. So many times people come to me and they think that just because they've owned a property 18 months, they qualify. Well, I want to know what they did with it in that 18 months. Did they buy a piece of land, start building a building, and then sell it? Well, if the building was just CO'd, then the building was just created and it was not held for investment. It's not going to qualify. I've got a lot of people in resort areas, and I know this doesn't affect commercial brokers so much, but they bought or owned in the Hamptons or in Spring Lake, and they're getting incredible offers on their property now for sale, and they want to sell it. Well, do they qualify? And it depends. If they've only used it as a vacation home, they're not going to qualify. They have had to have held it for investment. Alternatively, if they bought the home and they were fixing it up, and they, in the middle of getting fixed up, got an unsolicited offer, they've held it very short time, And so they likely don't qualify either. So the IRS will look at various factors. They want to know what your ordinary course of business is. Are you a dentist or are you a real estate investor as a business? They're going to want to know how many 1031s or how many sales you've done in the last couple of years or a certain amount of period. Because if you've done too many, you become a dealer or somebody that's a flipper, primarily holding property for resale. So that will taint you. Now, this issue also comes up when I have a transaction where somebody is right before closing trying to change the tax owner of the property. And how might that come up? Well, if we have a partnership and some of the partners they all want a 1031, but they want a 1031 separate, independent of one another, then they're going to want to convert, and I'm going to talk about this after Roy does a little bit on DSTs, but they have to convert to what are known as tenants in common and liquidate that partnership. They have to do a drop down. Well, now, for years and years, we had a partnership filing return, and now all of a sudden we've got, forget the K1s, they're gone, the partnership's gone. Now we've got individuals on the deed or single member disregarded LLCs on the deed, and that's a change of tax ownership. And now they sell right away. Did they hold for investment? So those are the types of things that we'll see. Do not change title when you're considering selling investment property in a 1031 without consulting a knowledgeable qualified intermediary and your CPA. Because if you do change title in a way that changes the tax ownership, you could disqualify your exchange. So I've got people, we owned it individually, but we just put it into an irrevocable trust 2 months ago for estate planning. Well, you've just destroyed your 1031 qualification because that trust hasn't held the property long enough to qualify as having held for investment purposes. Now, as I mentioned here, the holding period is only one factor. Let's have a little bit of a guidance on that, though. A year without resale activity is considered the liberal view as to what is needed to hold for investment, and 2 years is the conservative. Again, we want a clean holding period. We want a holding period that doesn't involve resale activities. Listing the property with you, all brokers, for sale is resale activity. Listing it for lease is okay. Listing it for resale is resale activity. Now, of course, you held the property for many years and it's a shopping center or it's an office building, you're going to list it, but you've already established through tax returns and actions that it's been investment property. It's that that listing with brokers will end up disqualifying if you buy the property and let's say 3 weeks after you buy it, you list it for resale. Well, then how could you have been planning to hold it for investment? And the determining factor is what your intent was when you bought it. Now, intent can change, but if it changes in a short period, you may have an issue qualifying. All right, so now let's switch gears. Let's talk about what is considered like-kind property because people get confused. They think if they're selling a fourplex, they got to buy a fourplex. If they're selling vacant land, they've got to buy vacant land. No, anything you hold for investment that's real property can be sold, and anything you hold for investment that's real property can be purchased as replacement property. This would include everything you see on the screen: farmland, timber rights in certain states, shopping center, industrial, vacant. All of that you see that might be timber rights up there at the right-hand corner, and including on what will qualify are Delaware statutory trust, which Roy is going to talk about shortly. Now, I know this is a seminar for commercial brokers, but you always want to ask me this question because it's always relevant, even though it's not a commercial transaction, and I'm going to address it. When can a vacation home qualify? Well, there are very stringent requirements on qualifying a vacation home, whether you're selling or buying it for 1031. And basically the requirement is if you're selling a vacation, quote unquote, home, you need to have, for the last 24 months, rented it each of those 12-month periods for at least 14 days a year for fair market rent. And the fourth bullet point is the one that is the most difficult for most of my clients to fit within when they didn't know this in advance. For those 2 years, your personal use and that of your family cannot exceed the greater of 14 days or 10% of the time rented. So with a seasonal rental and you're renting it for 90 days, that means 14 days is going to be as much as you're ever going to be able to use it in the last 2 years. So I've got clients calling me with fabulous contracts for sale of resort area properties. they're getting great money and they don't qualify. They're not, it's not their primary, it's not investment property. They're going to have a very ugly tax bill. So again, planning is the most critical part of every 1031. Had you known this 2 years ago, you could have gotten your ducks in a row with your renters and your CPA and your actions to make sure you qualified. So very critical to understand this. Leaseholds also can qualify. Now this is relevant to you commercial brokers, because is it leasehold a fee? Well, a leasehold is real property because it's a lease to rent and use real property. But is it like kind to a fee, which it also must be? Only if at the time the leasehold interest is sold or given up or terminated, you have remaining, the exchange has remaining on the term of the lease 30 years, including unexercised options. If the landlord comes along and says, hey, Amazon's buying the whole building, I want to end your lease and you have 20 years remaining with 2 10-year options, and I'm giving you $10 million, before you accept that, before you terminate the lease, let's get an exchange set up, and you can consider that sale to be the sale of qualifying real property, and you can buy any other kind of real property you want. It doesn't have to be another lease. So it's a broadly written provision, but you've got to have that term remaining or it will not be considered like kind to a fee. A short-term lease, 10 years, is still real property, but it's not like kind to a fee. So the best you could probably do is sell a short-term lease and buy a short-term lease, which most people don't have an interest in doing that. Okay, we are getting to Roy, because one of the most powerful types of replacement property in today's market are what is called Delaware statutory trusts. And they are covered by a revenue procedure. So someone buying an interest in a DST is certain that they qualify for 1031 purposes. Second, and very importantly, it's one of the exceptions to the rule where you can buy an interest in a trust and qualify. And it is also one of the very limited situations where you can buy a fractional ownership interest in real property and qualify. So my clients, their biggest difficulty today, and part of it's because of COVID, part of it's because of what happened in the marketplace because of COVID, is they cannot locate and close on their replacement property in time. So I have people liquidating $40 million sales because of this and paying boatloads of tax. So it's very critical that are helping the investors line up their 1031, that you realize what options they have to where they can go to find replacement property, and they could put all their money into the DST, or they could put some of it as a backup, or maybe they found something but it doesn't use all of their value and they need to use the value in another area as well, and DSTs can provide that solution. So with that introduction, Roy, why don't you take it away and talk about DSTs?
Sure. Thank you so much, Pamela, and thank you everybody for your time and joining us this afternoon. So, yeah, I want to teach you guys and everybody that's on the call about DSTs. I'm sure some of you are familiar with these or hearing them. They're becoming very popular. Our industry is expecting it to be a $4 billion industry. So, so I like to present these ideas as concepts to kind of teach and work with commercial brokers on ways that they can incorporate this into getting more sales, helping their clients find solutions, like Pamela mentioned on the identification sheet, or just, becoming completely passive in general. So just to highlight this slide, there is an IRS revenue ruling 2004-86, which basically lists a bunch of things DSTs can and can't do. But as Pamela pointed out, the good thing is we know that this is an approved investment structure for investors that are considering 1031 exchanges. The one big caveat is that you have to be an accredited investor, which means that you have $1 million of net worth or more, or if you're earning $200,000 of income, $300,000 married filing jointly in the previous 2 years and years to come. So there's really three things that I want you guys to kind of think about when it comes to DSTs and different opportunities that you might be able to bring these ideas to your clients or just incorporate to in your practice. So where I work with a lot of commercial brokers is, using the DST as a carrot on a stick. really because of the way they're structured. Oftentimes you may come across a situation where you have a client or an investor, they've been sitting on this property that they've had in their family for many, many years, and they want to sell it. You as the professional broker know that now's the best time to sell it, but they're afraid of Uncle Sam, who's rubbing his hands together because he knows that there's a big chunk of tax money coming his way. And your client may not want to buy something new. They know the headaches that they have. So why would they sell it to buy new headaches? They're comfortable where they're at. Well, the DST can really present the opportunity to get them to list that property with you guys. So as a DST investment, it comes as a fully packaged investment for you as a commercial broker and your client to review everything about it. So the institutional sponsors that are in quotes, familiar names that you may know, Cantor Fitzgerald and JLL, all put together DST packages and DST investments for investors. So it's not just any random real estate institution that is putting these together. There are significant real estate firms that focus on this product for investors. So some highlights: they have a very low minimum, and we'll go into why this could be a good thing as well when it comes to identification issues. But typically it's $100,000. So on $1 million sale of a building, you could truly build a diversified portfolio of different real estate in different geographic locations and different sectors for your client to become a truly passive investor in. Again, it comes fully prepackaged. So if there is debt associated with the property, you will know what level, what LTV is on the property, the loan terms, and that debt is non-recourse to the investor. So another thing I like to kind of teach real estate brokers, especially commercial brokers, are, sometimes you may have a buyer that can buy a replacement property, but they might have trouble getting financing. So there are DST solutions that focus on high leverage, where you can take a minimal amount of capital, satisfy the debt you need to replace in the 1031 exchange, and then go have that investor buy all cash on the property that you're presenting them. All of the due diligence is disclosed in the private placement memorandum. It's a tremendous legal document that goes on file with the SEC, and you get to know everything about that property. If there's structural issues, if there's improvement needs, whatever the case may be, all of the risks associated with it are disclosed. And all of the DSTs are really built to provide an experience for the investor. So again, when you have that older client that may be looking to liquidate their portfolio, they're not sure what to leave behind to their kids, they don't know what Uncle Sam's going to do when they sell that property, you could work by presenting them, hey, here's a fully prepackaged investment program that would allow you to defer your taxes. You're able to diversify in self-storage, multifamily, maybe medical office building, triple net lease portfolios, collect a monthly income, and truly become a passive investor. You can go to the next slide, Pam, please.
Boy, I want to say two things before you continue.
Of course.
So two things, everyone. So most people come to me and they're asking about a DST, but they ask for an interest in a REIT. This is as close you can get in a 1031 to buying an interest in a real estate investment trust. Interest in REITs are shares of stock, they're personal property, they don't qualify. So this is as close as you can get. Second point I want to make is Roy is indicating that you can provide them with XYZ. No, you cannot. Roy has to do it. Roy is the broker dealer. These are licensed securities for security law purposes. So unfortunately, commercial brokers, unless you have your whatever securities license, can't sell these. That's why Roy is part of your team. Back to you, Roy.
Thank you, Pam, and I appreciate that. And exactly like Pam said, right? My goal for everybody on this call and even your friends and colleagues is to be a resource to you and help you. I want to sit on the same side of the table as you. So if you were to sit there and say, hey, I have a client that's looking to sell a $10 million building, I have these properties lined up, how could we present something to him? Even again, like I said, if it's the carrot on the stick that keeps him running on the treadmill, I have no problem playing that role, right? I want to be there to help you guys. And by using the DST and bringing my expert knowledge to you, hopefully that will entice the client to be like, oh, you know what, this is the right thing for me in this period of time. So just some quick highlights, and then we can go to the next slide because I touched on some of this stuff. So they are already a liquid investment. The average hold time is, we tell investors to expect to be invested for 7 to 10 years. The average hold time really falls between 5 and 8. And the great thing, the reason why I bring that up is even if this investment is solving a temporary problem, so your client's up against the 45-day clock, they don't want to pay the taxes and they identify a DST, but now they want to go back to direct real estate once the program is liquidated. Well, they can do that. When the DST sells in between years 5 and 10, you get to do a 1031 exchange all over again. We can call Pamela back, and then we get to work together and say, hey, this client is working with Leo, and they want to buy direct real estate this time around, and you could certainly go ahead and do that. Another great thing is there's no capital calls. All of the DSTs are funded with reserves. So all of the projects and everything that needs to be improved in the property is being taken place up front when the investment's being structured. So the client doesn't have to worry about, they need a new roof, there was an insurance claim, they have to repaint the parking lot, now they have to throw extra money towards it. They actually get to just let the sponsor do their thing during the life of the program. Again, as Pam pointed out, these are securities. So the closing process is really easy and efficient. It's probably a total of 3 to 5 business days. But the great thing about that is once the client is closed, they can begin accruing income on that money right away. So if you closed on April 15th, you come May 15th, you would receive an income check for the remaining days of April, again, because it's an already performing asset inside of the trust. And what we will go into now are some examples of where this could really help different ideas, right? So we talked about boot, we talked about identification. So this is an example DST. It's a 300 unit Class A multifamily. Let's just say that it's an $80 million offering price. So there's going to be $40 million of equity, $40 million of debt. So that gives us the 50% LTV, excuse me, and a 5% first year stated distribution. So in this scenario, we're going to use just a $200,000 sale just for easy math. So when that investor sells that $200,000 property, $100,000 was paid off at closing for the mortgage. And now let's just say net of fees and all that, there's $100,000 to invest, right? So now in this solution, this is where the client just knows that they want to become passive and they have debt to replace and they just don't want to find any other replacement property. So when you take that $100,000 and you invest into example DST, you're going to own a pro rata share of that DST. So because the debt is already existing, you're also going to own a pro rata share of that debt. So on your closing statement, when you put $100,000 into a 50% levered DST, you're actually going to reflect $200,000 worth of real estate being purchased. And in this scenario, you would have satisfied your 1031 exchange requirements of replacing what you sold and investing all of your equity. So this is a great, easy solution. Obviously, this can be scaled up or back depending on the client situation. And because the DSTs are prepackaged, often you'll see debt anywhere between 45 and 55% LTV. So if there's a specific debt level or debt number that we need to match, we very often can do that. Here's some good examples just for identification issues and boot issues, things like that. What I like to call maximizing your identification. So the 3 property rule is the most common. That's where you get to list 3 properties for unlimited value. And I don't mean to steal Pam's thunder because I know she touches on this in a little bit. But ultimately, if you're presenting your client with real property 1, real property 2, we can list the DST as real property 3, and that will actually act as your emergency parachute. So in the event that, God forbid, those properties fall through, something goes wrong in the due diligence period, we could actually have a DST there that can act as a backup. And then going to what I was just speaking about, 5 to 8 years down the road, when that DST gets liquidated, then you could work with your investor again to bring them a solution. But they might look at you as a hero because you just kind of saved them from throwing Uncle Sam a big chunk of money. The second one is the 200% rule. So this is when you sell your building, but you want to identify more than 3 properties. So you're allowed to identify up to 2 times your sale price. So here you sold for $1 million. You want to list, 3 properties at $400,000 each, but we can list 2 other DSTs behind that as backups to those. So we could use, instead of using the 3 property rule, we use the 200% rule, and we list 2 other backups. So now we're protecting 2 $400,000 investments rather than risking that something goes wrong. The next example, and then I'll give it back to Pam, is boot issues.
Did I miss a slide? Okay, sorry.
No. I just want to touch on this really quickly, and then I'll let you take the wheel back. So boot issues. So boot is, let's just say you sold a property for $1 million all cash, and you find your investor an $800,000 replacement property. That difference of $200,000 is what we call boot, and that is going to be potentially taxable depending on the client situation. So again, because the DSTs have low minimums, we might be able to take a small portion of whatever remaining equity they have left over, right? Because maybe they don't want to buy up and buy more. They have one opportunity that they love that is less. Well, we could take the $200,000, invest it into a DST, and now that client can collect the monthly income on that money, and they've satisfied the exchange with the property that you've bought them, and then covering the taxable boot with the Delaware Statutory Trust. So there's a lot of different scenarios. I think the biggest takeaway, as I kind of wind down and give the presentation back to Pam, is just feel free to use me as a resource. There's a lot of different nuances and ways to work this into your practice, and I'm happy to be and happy to help you any way I can.
And Roy, on this issue, let's tie in the 1031 rules. What you have to recognize is that after the 45 days, you're locked into what's on your list. That's why it's so critical to have backups on your list. If you want to use the 3 property rule, great, but there should be perhaps 1 you are going for and 2 backups. And then maybe you want to use the 200% rule because either you want more backups or you want to actually close on more replacement property. So it's very critical to use these rules to the max to ensure your 1031 is safe. And the other issue I wanted to point out on this slide is that many questions come up, well, what am I buying? And there's an Amazon there. So Roy, before we go back to me, give an example. I mean, that's the hot ticket right now in DSTs. That's gone. That's sold out in day 2, right? But what are the types of properties that an investor could expect to find in a DST right now? If I called you and I said, Roy, I have 200,000 or 2 million, what could I expect to be finding as types of real estate?
Sure. No, and thank you for that question. So right now, the biggest thing where there's a lot of competition, I'm sure everybody on this call knows this, is the multifamily space. I think it's a very big flight to safety. Anything with a lot of doors. So right now, if you called me, we'd be discussing properties, Colorado, Texas, Florida. A lot of the sponsors try to aim for some high growth areas, but they're going to be anywhere from 250 to 400 unit Class A multifamily apartment buildings. There's a self-storage portfolio coming out. The big A word, Amazon. Anytime there's an industrial property that a sponsor can get their hands on with Amazon behind it as a tenant, those sell like Pam said. There was a deal that didn't even make it into the broker dealer channel. It was sold out within 2 days just because it was an Amazon distribution center. So they do move very, very quickly. And that's why, I say, just use me as a resource. I have no problem educating you, your client, whatever the case may be. This way you could be as aware as possible, and hopefully it helps you get more business.
Thank you, Roy. Thank you for that added explanation. So I already mentioned this, so I'm going to pass by it. REITs don't qualify, shares of stock. Okay, so what requirements that are behind a 1031 that could come back to haunt you if you're not aware of them from the very beginning, the planning stages? The same tax owner has to be buying and selling. So the first thing is we've got to identify the tax owner. Every time I get a contract and an LLC is selling, I've got to dig into that LLC and say, does the LLC file the tax return? Is it a single member disregarded LLC? Does the sole member file the tax return? And just so you know, that's whatever we decide who is the tax owner on the sale has to be purchasing. That does not mean title has to be in the same name. You can have an LLC buy replacement property that's a single member disregarded entity, and as long as the sole member is the same as the exchanger tax owner that sold, we've got a perfect exchange. That's more for the lawyers, but this is something, the next couple of slides are really something that very much is part of a commercial broker's world. Most of our clients, most of your clients today that own commercial property, that's owned by multiple investors, even if it's part of the same family, they own in a multiple member LLC, with the investors owning membership or partnership interests and getting K1s. So first note, those partners don't own real property. They own personal property. The partnership or the LLC owns real property. The partnership or the LLC can do the 1031. But if the individual partners want to do a 1031 on the sale of that partnership asset, then the partnership needs to restructure how they own the property in some way before they sell. And the most common ways to restructure, there are two. One is known as a drop and swap, and the other one is known as a swap and a drop. And basically, it's the same restructuring, but one takes place before the sale of the relinquished property, and the other takes place after the purchase of the replacement property. So it's a timing issue. And in both situations, the partnership is going to liquidate and distribute the partnership interest to the investors. So if I look at title, I'm going to have the actual investors on title after the drop down is completed. And the investors might take in their individual name, probably not with commercial property. Probably every investor will form a single member disregarded LLC. And so now we have multiple owners, multiple tax owners. But do they hold for investment? Well, if we do a drop down, we convert this, and then they hold their what is resulting tenant in common interest for a couple of years, certainly. But if they do it and they drop down today and they're closing tomorrow, it's a very short-term hold, which can pose other risks in the 1031 world, as we're going to see shortly. Those that want no risk will simply go ahead and do their exchange as a partnership, and after the partnership acquires replacement property, they will then convert to tenants in common. When? Well, not right away, because we want that replacement property to be held by the same tax owner, that is the partnership or the LLC, for an investment period. So we really don't want to see a drop down soon after closing. We really want a year or two to go by before any distribution occurs. Some of the issues that arise have to do with what's called the court holding case, where the drop down was done and then they did the exchange and the IRS said, no, not going to qualify for 1031 treatment. In this particular case, there was a corporate case and there was a redemption of shareholder interest right before closing. So the shareholders got their proceeds directly, and the court said, no, we are not going to recognize that, because it's simply what they called a step transaction. You were just trying to avoid the corporate tax on the portion of the proceeds that went to the shareholders, because it was corporation. So they had two levels of tax. So these are the types of cases we look at if we have a situation where a client is trying to change tax ownership right before closing. So there are many, many solutions to partnership issues. You could call me and say, I've got some partners that want to exchange and others that don't. What do I do? Or I've got core partners that want to stay together. One wants to exit. He's due about $1 million. What can I do? I'm probably going to talk to you about what's called the partnership installment note solution. But in our program today, we don't have time for all of the solutions for partnerships. Just be aware, if partnerships are separating in any way and there's a 1031 contemplated, you've got to get a hold of a CPA, tax attorney, and knowledgeable qualified intermediary sooner rather than later, so that you can address the potential risks and how best to restructure and when best to restructure. Okay, so Roy was alluding to boot and what your exchange equation is. Well, your exchange equation basically requires you to trade up or even in value and spend your equity. All right, so what does that mean? Our value here is not 5. It's 5 less our exchange expenses, which are broker's commissions, legal fees, transfer taxes, recording fees, and so forth. So our value here is really 4.7. That's the amount we need to spend. Now, what astonishes many people is that this debt amount of 2.5, it gets paid off when we sell the relinquished property. That money doesn't come to the exchanger. However, they still need to replace it to get full deferral. So they replace their 2.2 if they want full deferral, and they replace their debt. They get new financing on replacement property of 2.5, or they can replace it with cash from another source. In this example, they didn't do that. They traded down. They only replaced $2 million of debt, and they only used $1 million of equity. So they put $1.2 million of equity in their pocket, which is fully taxable as cash boot, and then they put what? 500, they didn't put 500 in their pocket, but they reduced their debt by 500, which means they had mortgage boot of 500,000. Both are equally taxable. Total boot in this would be 1.7. At best, this is a partial exchange. Anybody wants to do a partial exchange, we should discuss it before they go and before we begin the exchange process, because dependent on their adjusted basis in the relinquished property, they might not have gotten any benefit by doing a partial exchange. What am I saying? Well, don't want to go into too many technicalities, but they're going to end up paying $1.7 million of tax here. Tax on $1.7 million of boot. If their gain was only $1 million, if they had liquidated, then they didn't do themselves any good, because you pay tax on your $1.7 million boot up to the full amount of your gain, which was $1 million. So if that's the actual case, they're going to pay tax on $1 million with and without this exchange. So that's why when we know up front we're not putting everything into the next deal, we have to have a consultation before proceeding. Now, this could also happen by accident, right? What if we identified plenty of property, but we weren't able to close on everything? Well, then we have boot and we did our best. So if it's intentional and you know it in advance, we have to have a discussion. If it happens by accident, well, we did our best. Now, for commercial brokers, if your client is trying to sell property and they had a contractor, they had a buyer, and they had this buyer lined up before COVID, and then COVID came along, now buyer can't get their financing. How many of you are in that situation where your deals aren't closing because the financing is not coming through? So what happens? Many times the seller turns around and says, look, I'll take back the note. I'll finance the deal. Well, that is going to upset your 1031 apple cart. Because, and I'll give you an example, let's say we're selling for $5 million and the client was supposed to come to the closing with $5 million, but they couldn't get their financing. So now they're going to come with $2 million and they're going to give you, the seller, a note for $3 million. That's going to really probably limit or eliminate the ability to do a 1031, because the only cash they're going to have to put in the exchange is $2 million. That $3 million, the note, is going to be taxed on the installment basis as and when the proceeds are paid to the seller. So that's an installment sale, and the $3 million is boot. So the only portion they could put into the exchange is $2 million. And if their basis was like $3 million, so their total gain was $2 million, it's not going to do any good. It's a partial exchange, because $3 million of the proceeds is not going to be included in the 1031. So do not agree to seller financing, unless you've talked to your advisors in advance. There is a way to include the note in the 1031, and that there are a couple of tools, one of which is used more times than not. But your seller has to be liquid. The note is made payable to the qualified intermediary. So $3 million note payable to asset preservation at closing. We hold the note and we hold the $2 million of cash. Sometime before the replacement property is purchased, either somebody has to liquidate the note. It's generally the seller. They're liquid. They give API $3 million. They take the note back. The whole $5 million is in the exchange account used to buy replacement property. When the payments are made on the note, they don't get a tax liability because they deferred it in the exchange. It also can happen if you have a short-term note. Let's say it was just bridge financing, and within 90 days, the buyer pays it off. And so we have the $3 million the buyer just paid plus the original $2 million, and you can complete your exchange. If the note is made payable to the seller at closing and not the QI, there is no way to include the note in the exchange. So it's a really critical difference. I think the main point here for commercial brokers is that do not let your seller blindly agree to seller financing if there's a 1031 on the horizon, because it will put a thorn in your process. Okay, so Roy and I have talked about the time periods quite a bit, so I won't belabor the delayed exchange timeline, but both periods run from the sale of the relinquished property, not the contract, the sale to closing, and it's 45 days to identify and 180 days to close. And the QI holds only one thing in a forward exchange, that's the cash from the sale. So this is the timeline. And then we've talked about what you need to do. You need to get us a form. So people call me and they say, oh, we already identified. We haven't even started the exchange. I said, no, you cannot. Identification is a formal process. that you can only comply with once your sale has closed. And sometime between sale closing and 45th day, you need to send the qualified intermediary a list of anything you might want to buy. That's what you need to do for identification. And your exchange period will end on the 180th day, or it could end earlier if your tax return is due or filed earlier. That doesn't happen this time of year. It happens when I'm closing in December and on April 15th filer. So April 15th comes before my 180th day, and I would need to get an extension on my tax return to get the full 180. Roy already mentioned these rules quite a bit. I'll just mention that if you list more than 3, then you've got to follow the 200% rule. If it's audit time and you failed both 3 property rule and the 200% rule, you can still pass muster if you actually bought 95% of the value of all the properties identified, which basically means you have to buy everything. So in my last 8 minutes, I want to just touch very lightly on reverse and improvement exchanges because they are on the rise. And I just opened 2 this morning, very complex. They're always complex. It takes me 10 times longer to open a reverse exchange than a regular exchange, and getting the information with the client and having the client understand what's involved is extremely time consuming and important. So it really would help if the commercial brokers understood what this meant. And then you could provide some guidance to your client. First of all, a reverse exchange is determined by whether and when you are closing on the replacement property. You only have a reverse exchange if you are required or planning on closing on the replacement before you've closed on the sale of the relinquished. Contract dates do not matter. It doesn't matter that you contract to buy the replacement property on June 1 and you contract to sell the relinquished property on July 1. As long as relinquished property closes on the sale before you close on the replacement, it's still a forward exchange. Okay, but why are we seeing so many reverse exchanges? Because people want to take advantage of opportunities in many cases, and there is a very competitive bidding market, and they're not going to get it if they don't move. And another reason they're seeing it is we are still seeing delays on the sale of our relinquished property because buyer can't get their financing, it's taking more time to get their financing. Due diligence has been extended because of what? We couldn't even get in the building for a year. All these kind of factors. So there's a large increase in replacement property reverse exchanges. Now let me point out, these are not for the faint of heart. They're much more expensive. Anytime we're going to buy before we sell, the qualified intermediary not only has the role to hold the funds, but we also have to take title to real estate. We either have to take title to what's being sold or what's being purchased, and we set up what's called an exchange accommodation title holder, EAT, acronym EAT, to take title to one or the other. So a lot of information I could give you about the parking arrangement. We don't have time. I have a whole seminar webinar on reverse exchanges. But basically, most times we park the replacement property for a variety of reasons. Let's go on and talk about the other 2 types of safe harbor exchanges, and then I'll come back to more detail on each. So I often get asked, I'm selling for $3 million. I'm going to buy a property for $1.5 million and make improvements. Can I use the balance of my 1031 1.5 to make the improvements? Yes, provided we set this up from the get-go as an improvement exchange. An improvement exchange requires the to-be-improved property be parked with an exchange accommodation title holder, an EAT. So the seller doesn't sell that new property to your client, the buyer. The deed will go to the EAT, the EAT. And we can park it for up to 180 days, and your client gets credit for whatever work is done in that time period. Does not need to be CO'd. Hard and soft costs count. So really, it's important to understand that you are limited in time, but that you don't have to be CO'd at the end of the time. You really should have your permits in place before the purchase takes place, or you could use your 6 months, especially in New York, just trying to get your just trying to get your permits. And a reverse improvement exchange combines the 2 structures. You're both buying replacement property first, and we're not only parking it because you're buying it first, but we're parking it because you're planning to make improvements. And you have to understand that for the IRS, you don't get credit for any value of improvements made to the replacement property once the exchanger takes title. So by parking the replacement property, we can give the exchanger up to 180 days to make improvements and get credit for what has been done in that time. So here's how it would look to perform a reverse exchange where we park the replacement property. There's your EAT. Here's our deed. It goes to the EAT. Look, if you're financing this purchase, we got to get way in front of this. The lender has to understand the borrower is not Mr. Exchanger. It's the EAT. So, you have to really understand the structures. And then for those of you that are concerned, even though we're parking the property, from the world looking in, your client owns it. We net lease it back. If there's construction going on, we enter into a construction management agreement. Your client has full control. We are just on title. So nobody would even know that you're doing a reverse exchange. And then the maximum time period to sell your relinquished property is 180 calendar days from parking the replacement. Hopefully you do that. Once you do that, the funds come in. We deed the replacement property to the client, and we pay the client the funds from the sale. So, on a diagram, it looks fairly simple. You cannot believe the issues. They are extensive. Okay, so sometimes we'll park the relinquished property, and if we do, and you were getting finance on the replacement, the loan is much easier because the lender's not dealing with the EAT. The lender doesn't even need to know there's an exchange going on. Lender's just making a loan on replacement property that is owned by the borrower from day one. So it can make that process easier. And here's what an improvement exchange would look like again. What are we going to park? We're going to park the to-be improved property. Okay, we're going to have a construction management agreement in favor of the tax owner so they can do what they want. They have 180 days from the earlier sale or purchase. So if you sold on June 1 and you bought replacement on July 1, you've lost 30 days of your 180. Okay, that's the period for the improvement. You don't have to be CO'd. Here's an example of how it would look at the end of the day. If you did a $5 million sale, came out with 4.7 of equity, and you spent $3 million on the lot, $1.2 million on the site work, foundation 500, you're not done, but your 180 is done, and you spent your 4.7, and all is good in tax land. So, structuring, planning is very, very, very critical. I believe I am at the end. I just, maybe in 1 minute, talk about the importance of selecting the proper qualified intermediary. Do they even do reverse and improvement exchanges? That'll tell you how experienced they are, because these are not for the faint of heart. Are they backed in writing by a large credit-worthy entity? Our parent is Stewart Title. They offer every exchanger a written letter of backing. Backing the funds we hold. We've never had any claim under LOA. We've been around, 26 years, the parent 125 years. These are the questions you want to ask. Why? Because anybody can be a qualified intermediary. Okay, you don't have to have any expertise, financial backing, or experience. So you want to protect your exchange from disqualification on audit. You want to have somebody you know can answer your questions, structure it properly, and have financial backing. God forbid anything happens in the markets or to the funds by inadvertence or anything else, that you are going to be covered. Contact information from me, contact information from Roy. We are both free resources to you, so please feel free to call and ask us questions as they come up. And a very, very, very big thank you to Christine and Leo and CIBS for having us here today.
Okay, Sam, that was excellent. Very good. A great presentation.
Speed talking.
Can you hear me? I'm sorry.
I can.
We got you.
I'm sorry. And it's great to have the PowerPoint for reference and your contact information.
I did send you the handout, I think, and you can distribute it to the attendees.
Yeah, well, yeah, you had emailed it the other day, so I do have it. But no, it was excellent, very informative, and lots of information there.
It's like drinking out of a fire hose. That's
No, you covered a lot of ground there in an hour, but it was very good. And like I said, we have the PowerPoint for reference, so you can go back and read through it and so forth. So,
Thank you very much.
Thank you very much. Good job.
I don't see any questions in the chat or the Q&A, but if any of the participants have a question, you can reach out to either of our speakers directly, or you can forward me your question and I will, of course, send it along.
I mean, we do come across this quite often, you know, you know, it's, these questions do come up all the time. So it's good to have, great to have the resource to, to give our customers the accurate information.
Looks like Steve might have a question. I see his hand raised.
Hand raised, is it in there? You see a hand raised, but is there a question in the chat bar? Oh. I don't know.
See that? I do see.
Yeah, I don't see a question.
Well, I can hold on one second. Let me see where he is. And I'll allow him to talk. So hold on one second.
Oh, perfect.
Okay.
Okay, Stephen?
Stephen, you're muted.
Yeah. Can you hear me now?
Yes, we can.
Okay. Two questions, but the first one very quick. Capital gains tax today in the 20-something% range. Let's say they change it to 40. We're doing the exchange this year. There's the question of retroactivity. But if I do the exchange this year, where it's 20-something%, and I hold it for 5 years and sell it at that point, is the capital gains going to be based upon what it is this year when I made the exchange, or when I sell the property 5 years down the road?
Good question. Your capital gain is based upon the year in which you liquidate. So not this year, 5 years down the road. However, your basis carries forward. So if you had a $1 million basis, you sold for 5 and you bought for 5, you still have a $1 million basis. So you sell that property in a couple of years for 7 million, you've got 7 minus 1, 6 million of gain.
Got it. And the second, it might lend to other people's questions as well. The scenario is, I got a building I'm selling for about $350,000. I was originally going to buy one in Florida for $400,000. Everything would have been nice and smooth. That fell through. So now the one I'm looking at is more local. It's about 500 change, which I can't afford myself. So I want to do it with a partner. So that would mean it would be my LLC as a 50% owner. I assume I could bring in another person as a 50% tenant in common, and it could be less than the 350 that I'm selling at, I assume, but I'll have that boot that I'll have to pay. But I guess the point is I can buy less and I can buy it with a partner as a tenant in common, correct?
Yeah. Okay. So you're using two words that are legally inconsistent. You can't be a partner and a tenant in common. A partner.
Well, not a partner. I shouldn't. You're right. Not a
okay.
Partner
So let's just making the distinction. Yes, you need to be a tenant in common. You can buy property with other investors in a tenant in common arrangement. Your pro rata share of the equity and debt needs to meet your exchange equation requirements to fully defer. So if you had $350 of cash coming out of a deal, and you were going to buy a part of property 50-50 with another investor as tenants in common, that property would have to be worth $700,000 to satisfy your exchange equation. And it gets even more complicated when there's debt on the replacement because everybody gets a pro rata share of the debt. But you are right. You can buy as tenants in common all day long. You can do that.
But could you say that part again, where the property that I'm going to buy would have to be worth, what were you saying? 750,000?
700. So if you had a deal, your client was selling for 350, no debt. So he has 350 of equity going into the qualified intermediary.
Right.
And he wants to buy a replacement property as tenant in common with one other investor. And they each are going to be 50-50 on the new property. Right. That would mean the new property would have to be valued at 700 in order for 50% to equate to the 350.
I see. So I couldn't even, the 1031 exchange would not even qualify unless that property was worth 700 or more.
No. If it was worth 500,
worth like 500, yeah, you could do
then you're getting 250. You've got boot of 100,000.
Right, okay, I get it. Right, yes, okay, I understand. And that 100,000, I imagine, I could put into another property
Correct. You could look by a DST,
or just buy another rental outright
whatever.
as a 50,
As long as
50 with some.
you properly identified it. You're getting the idea of how important strategy is up front. You don't want to think about these issues after the 45 days has passed. It's too late.
Right, okay, thank you.
Anybody else? Was that the question I see in the bar up here? What type of returns? Oh boy, this one's for you. Roy, here we go.
So yeah, I think that's a great question, Desmond. And to just touch on Steve's question, as Pamela pointed out, yeah. So like, in that event, you could certainly buy for less, and you want to make sure that your partner, that you're put partner in quotes, that you're buying that property with, the timing works out so you can acquire that property at the same time. But yeah, you can also invest any remaining boot into a DST, or like you said, buy property outright. And at the same time, we could use the DST to kind of back you up and insulate you from anything going wrong, whether it's on the boot side or just the overall purchase. And then to answer Desmond's question, the types of returns right now, it is certainly a compressed environment, and I'm sure that that is something that everybody is experiencing. So right now in the Class A multifamily space, depending on the opportunity and the location, it's nothing spectacular. It is anywhere from 4.25 to maybe 5.5%, but that's net of fees. So if you put in $100,000, you would get anywhere from $4,250 to $5,500 a year. That's paid monthly, and the DST does allow for back-end appreciation. And I would say in this environment, I think 1 to 5% per year on the back end is very, very fair. So the example I like to give is if you put in $100,000 and let's just say you held that for 5 years, the total return per year was 10%. So on $100,000, let's just say you collected 5% income. So you collected $25,000 of income over those 5 years. And then when that DST gets sold, you will get $125,000 back in principal to do another exchange with. So the opportunity for growth is there. It's definitely very contingent on the economy and the world we're in, especially coming out of the world of COVID. It will be quite interesting. But that's kind of why I define it as the DST experience. It is absolutely not a product that is meant to compete with the 6 to 9% level of income or the 15 to 20% IRR opportunities. They're really built for the retiring real estate investor, for people that are just exhausted from the 3 T's, the toilets, the tenants, and the trash. They're meant to be predictable and stable. This way, people rely on the income for their retirement and their lifestyle. And hopefully that answers that question for you there, Desmond.
Yeah. Okay, any other questions floating in?
Don't see any.
I don't see any either.
Okay, I guess we'll wrap it up then, Christine.
Yes. Thank you both for
Thank you.
a wonderful
Yeah.
presentation.
It was
And
really excellent. I know who I'm calling if I have questions. Roy and
Definitely
Pamela.
Pamela, yeah.
Oh, no, great job. It was very good.
Thank you. Thank you.
Yeah,
Appreciate
thank
your
you
time.
everybody for the time and the opportunity. We greatly appreciate it. And like Pam said, we are a free and open resource. I know that I have spoken to some people that have attended in the past and know them personally, but as you all know, just call us. That's what we're here for.
That's great. Appreciate it. Okay, thanks again. Have a
Thank
great
you.
day.
Have a
Okay.
wonderful day,
Thanks,
everyone.
everyone.
Be good.
Bye-bye.
Thank you.
Bye-bye.
Thank you.
bye-bye.
All right.